Hey, if you like predictions, you'll get a bold mortgage rate prediction from the president of one of America's most prolific mortgage companies today. She tells you exactly how high she expects mortgage rates will go, the why behind it, and even the timing of how soon we'll get there and more. I'm Keith Weinhold. This is GRE, that interview right now.
It's such a slippery slope. The Fed has said that they plan to start lowering rates in 2024. That was their words. I think it's going to be sooner than that. I'm going to be direct. I'm going to actually answer this question. My forecast is that by sometime between now and spring next year, we hit...
I would like to welcome in the president and CEO of Ridge Lending Group. She's a real estate investor herself. In fact, Ridge has helped more families realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation. Welcome back to GRE, Caeli Ridge.
Keith Weinhold, thank you for having me. It's always such a pleasure, sir.
Caeli, in the mortgage world these days, obviously, everyone wants to talk about higher mortgage interest rates. We know really that the direction of those has only been up since 2021. And a lot of people wonder, well, now I see that quoted 30-year fixed mortgage rate, that headline rate, but can I perhaps get a mortgage product with a lower interest rate than what the 30-year fixed offers? So can you speak to that, how to get a lower mortgage rate today?
When we're talking about trying to find ways to capture or recapture, rather, some of our cash flow back, because as the rates have risen, we know that we've lost a little bit in that cash flow. So what a lot of people are looking at is non-QM, outside of the Fannie Freddie, outside of the agency loans, non-QM adjustable rate mortgages, maybe interest only, both of which are offering some relief. I've always been a fan of both of the ARM and interest only for reasons I'm happy to share with the listeners. As of recently, before the rates started rising, it hasn't been viable, but we're now getting into a space where both of those things are back in play, and I believe will become more mainstream as the weeks and months go on.
Talk to us about those, an ARM and an interest-only product. I guess the plus side of that is how much lower is a mortgage interest rate? And then what are the cons?
Plus is going to be the cash flow, right? We're usually going to be, it depends on the variety of variables of the loan, okay? But you want to expect at least a 0.5 percentage point lower than what the 30-year fixed might be giving us, depending on the product again. Ideally on the ARM, we want to see a point better. It really depends on the deal. Interest only is also another way that we can extract a little bit more cash flow. If I may, let me just kind of segue into some statistical data. I know that for the last 12 plus years, a lot of us have really kind of been fixated on the only game in town being that 30-year fixed mortgage. The reason for that is that after the 08-09 crash, we've been on an inverted yield. Okay, this just means that 30-year fixed mortgages for the last 12 years have been lower than any adjustable rate mortgage. Right? Why would you take an ARM that's higher than a fixed? You wouldn't.
Sure.
Some of that is starting to change a little bit because of how quickly the interest rates have gone up this year. But let me kind of play into before 08-09, I would tell you 9.9 out of 10 loans that we would fund were going to be on an ARM because the rates they had that spread. The counterpart was going to be a 0.5 percentage point lower. Now the statistics, I think that we've talked about this together before. So let's take a 30-year fixed mortgage. The percentage of people that start with a 30-year fixed loan and make 360 payments later to pay it off is less than 1%. It's
Right.
Literally a fraction of percent. So very, very, very rarely does that ever happen. I know that currently the shelf life, the average shelf life for a 30-year fixed mortgage for owner-occupied, the home that you live in, is about 7 years. So we know that investors are somewhere around 5 or 6. So if you know that, right, and we do find ourselves back in that place where adjustables are lower rates such that it is appropriate spread, why would you take a 30-year fixed mortgage that you're going to be refinancing to improve rates? Because when rates go up, do they stay up? No. When they go down, they don't stay down, unfortunately. But we're going to be refinancing at some point. So you're not going to take a higher rate because you're going to be refinancing to reduce the rate, pull cash out. Maybe you're selling and doing 1031 exchange. So the ARM is going to start making more sense in this new cycle that we're embarking on. The second piece of that would be the interest only. If anybody has ever looked at an amortization table or the truth in lending disclosure when they get a 30-year fixed mortgage and they look to see the first 10 years of payments, how much of that is really going towards the principal, it's probably about this much, right? Very, very little is actually being applied. because it's amortized over such a long period of time, the investor that's lending this money, they want their interest. They want to be assured that they're going to get as much of the interest as they can. You're not plunking down to the principal until the back end. So for those two reasons, I've always, under normal circumstances, been a big fan of the ARM and the interest only, and we're starting to see that become more prevalent in how we can attract more cash flow.
If you as an investor are looking at that typical 5 to 6 years for the period of time in which you're going to hold onto a loan product, it's really difficult, exceedingly rare to find any 5 to 6 year period where real estate is not up on a nominal basis. That's for you in case you have concerns about refinancing after that initial, say, 5 to 6 year hold period.
I absolutely agree. I would say that we're going to find ourselves, the forecast for this, rates are up. I believe they're going to continue to go up. In the next 2-3-ish years, the math is going to be fairly simple to figure out when it's going to be time to refinance based on the cost of the refinance and the savings and the rate that you started with versus the rate that you're going to get. But I can almost guarantee you that for investors especially, the vast majority, over 90% of the mortgages that are secured today are going to be refinanced in the coming years.
Yeah, that makes a lot of sense. And in fact, Caeli, I've been wondering, is the reason that the spread of the 30-year fixed rate mortgage is so high above the yield on the 10-year T-note right now, is that because banks are pricing in that as a sort of risk premium because they're afraid that they're not going to be able to collect very much interest from the borrower because that borrower might run a refinance in just say 2 to 3 years in case rates go down then. So therefore lenders are building in that cushion above the 10-year T-note greater than that traditional 1.75% average cushion?
Very nice, Keith. Absolutely right. And just to kind of take that further for those of you that might not be totally clear, what Keith is talking about is that when we talk about mortgages from a mortgage-backed security perspective, as an investment that is bought and sold and traded on Wall Street or secondary markets, right? It's important to understand that interest rates being as high as they are right now, the servicers of these mortgage-backed securities are paying a premium for the right to service these loans. The premium that they pay typically will start becoming profitable and about 3 years after they purchase the mortgage-backed security. Okay, so think about that. They need to wait 3 years before what they've paid as a premium for these mortgage-backed securities for them to become profitable before they're back in the black. But interest rates are high and they know they're going to pay off before that 3 year period of time, right? What does that mean? They're not going to be profitable. They're going to take losses. So one, yes, that's why the interest rates are higher. And then also the points associated with especially investment properties right now are in excess of what we've seen before. That premium pricing where you used to be able to get a 0-point loan, you're not getting that today for that very reason.
That makes a lot of sense. Okay, so lenders trying to hedge themselves, being sure that they're compensated in fees since they fear that they might not be able to collect enough interest over the years, since one can make the case that in 2 or 3 years, mortgage interest rates could be lower than they are now. And in the United States, unlike almost any other nation in the world, you, the borrower, are in control of that loan. You can refinance pretty much when you want to refinance, as long as you have adequate equity and credit, of course. So with that in mind, Caeli, can you speak any more about how one can get a lower rate than a 30-year fixed rate loan, and maybe how you would guide someone and show someone what their options are if they want to put 20% down on a 1 to 4 unit income property right now and yet not pay that 30-year fixed rate?
First, I'm going to find out what their goals are, short and long term, and then we're going to look at the variety of loan products available to them. And I would say even keep the 30-year fixed in the mix, right? So we'll look at the numbers for this. Maybe we look at the AllInOne, which is one of my favorite products. Maybe we look at a 5-year ARM, an interest only. And then side by side, it should be pretty clear to us based on the goals and this particular investment. It's going to be different for every opportunity that they're looking at, which is going to make most sense. So the ARMs and the interest only typically is where they're going to find the lower interest rate. And then we can talk about buying down points too, but more often than not, I'm going to say buying down further beyond the points that you have to pay right now to get the loan probably doesn't make a lot of sense, especially since we're going to be refinancing fairly certainly in the next few years.
And why don't you tell us, you offer so many products beyond just the 30-year fixed rate plain vanilla loan, and you deal specifically with investors. I mean, you are specifically engaged in helping real estate investors, not principal homeowners, buy properties. So why don't you tell us about what some of those other products are, including some that have quite a bit of flexibility, like your all-in-one loan product?
Yeah, our special skill set is definitely for investors. While we can do everything, it is kind of a primary focus of ours. And I think one of the real value adds, in addition to the education, some of the other cool things I believe about Ridge, it is the product availability. It's very, very diverse. Fannie Freddie, we've got non-recourse and recourse, debt service coverage ratio, bank statement products, asset depletion products, bridge loans for those fix and flippers, shorter term mortgages. We have commercial loans for commercial properties. Commercial loans can also apply to cross-collateralization of residential properties, if that made sense. Maybe, for example, you want to cross-collateralize 5 of your conventional loans into one non-recourse loan and open up more conventional loans. And then finally, my favorite, I saved the best for last, that all-in-one. This is such a unique product that still a lot of people just are not aware exists. This is a first lien HELOC that doubles as a mortgage and your checking and savings. It combines those two elements, the all-in-one. And it's a means of allowing you to become your own bank. You have this line of credit where your mortgage balance sits, and all the while you're able to deposit all of your depository income versus putting it into your regular checking and savings, same exact banking features, but instead of parking it over here in this vessel, you're simply putting it here and driving down your principal balance dollar for dollar so that the interest accrual cannot pick up speed, right? You're in control. There's so much more to it, but it's a rabbit hole, and maybe we will run out of time if I go down it. But the all-in-one, also interest only. You have this line of credit for 30 years, and you have control about how much interest is going to accrue on a daily basis.
The all-in-one loan. So you, as the borrower, have interest-only flexibility, meaning you only need to cover the given interest payment for that month, or you have the option of paying more. You can pay down some of your principal if you want to. And I know they're at your website at ridgelendinggroup.com. You also have the all-in-one loan calculator, so a prospective borrower can see what their savings might be compared to a different loan type.
Yeah, I really encourage anybody listening, check that out. The online interactive simulator will compare an all-in-one to either your existing mortgage or even a new mortgage. And it's very simple intake, guys. No vials of blood, right? That's my token joke. Very, very simple intake, 2 or 3 pages. The results page is going to be really, really clear on whether the all-in-one is more to your advantage, or maybe the 30-year fixed is. The math won't lie. So take some time to do that and see what it says. I might just offer that on occasion, the individual may not be entirely clear about what the input is asking. And if you aren't totally clear and you input something that is not what it's asking, the results page is not obviously going to be accurate. So be sure to check in with us, and we'll go over it with you and make sure that the T's are crossed.
Yeah, it's probably worth your time, at least checking on it. Maybe if it's for your primary residence, this could be your biggest ongoing payment in your entire life. They also do primary residence loans there at Ridge Lending Group. So it's at least worth checking out. Again, that all-in-one loan simulator is what it's called at ridgelendinggroup.com. I've certainly visited that page myself. Well, Caeli, shortly we want to get your mortgage rate forecast. But before we do that, let's talk about something else, appraisals, because you offer loans in 47 U.S. states, almost every state, and you see so many appraisals come in from different regions of the country, typically for income properties. Tell us what you're seeing with appraisals. Are they coming in high? Are they coming in low? Or most of them coming in spot on value? Tell us about appraisals.
They're spot on. I'll tell you, it's probably been, I would estimate, maybe 6 months or more. I have not seen a short value appraisal.
Not one.
Not one. Now, and granted, we do high volume, so I'm not looking at every single one, but I haven't heard of one. I haven't seen one personally. So the sky is falling sound bites that I'm hearing out there in the fringe. I would not give too much credit to. I feel like the values are holding pretty well. So no complaints, no issues that I'm seeing there.
That tells us a lot about stable values. Of course, we're beyond those 20% appreciation high flying days that we had in 2021. But because an appraisal is essentially a tool that the bank uses to validate the quality of their collateral, that tells you a lot with what they think about the market, and they're still willing to lend 80% of that because values are so stable in real estate, and they have been this year after they were so volatile last year since they were up quite a bit. Well, let's get Caeli's mortgage interest rate forecast next. I'm Keith Weinhold. You're listening to Get Rich Education. There is upward pressure on rents. And you can make this actionable at our sister website, gremarketplace.com. This is where you can leverage my industry contacts to get started with rental property. I own properties with a lot of these same providers across different U.S. states. Most of these properties, which I've actually never seen in person before. And how can I have the confidence to own rental property without ever having seen it? Well, for one thing, I partner with these turnkey real estate companies, which you can do as well. I'll see you over there at GRE Marketplace. You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. I'm your host, Keith Weinhold. We've got the president of Ridge Lending Group back with us today. A real treat, Caeli Ridge. She's been in this industry for decades. She's been a real estate investor herself. And Caeli, I joked with my audience before about how I don't feel very comfortable making interest rate predictions myself. They're so difficult to make that I'll ask someone else and let them be wrong about it. I'm sort of joking about that. You're probably not going to be wrong with what you say. In fact, I think that prices of real estate are a little bit easier to forecast than mortgage interest rates are. But I'd really like to get your insight on this. And, before you tell us that, Caeli, I think a lot of people were surprised about what's happening. Okay, the Fed had egg on their face because they were too late to respond to inflationary pressures, and now they're hiking up rates really fast in order to catch up. And I guess I didn't know that Jerome Powell had the guts to hike rates as many times as he has. I'll put it that way. Some people joke that on Jerome Powell's desk, he must have Paul Volcker's book there somewhere on his desk. Of course, Volcker is the Fed chief. They famously jack up interest rates to almost 20% 40 years ago. Yes, that's not an exaggeration. Paul Volcker, former Fed chief, hiked the federal funds rate to almost 20% 40 years ago. Of course, we have the Fed funds rate today at about 4%. Before you tell us about mortgage rates, how much higher do you think the federal funds rate can go, Caeli? Earlier this month, the Feds met, right? They have their meetings throughout the year. And what I heard Mr. Powell communicate to us and what some of the news outlets were trying to forecast for is that around 5% would be a threshold. I don't know that it'll go up that high. I'm not ready to give my 2 cents on that. But what I can share with your listeners, Keith, is that I believe that while the Fed is very, very clear that rates are going to continue to go up, I think that's a foregone conclusion. I do not believe that they're going to go up in the same trajectory and speed fashion that they have been. I think they're going to level off a little bit, maybe make a rate increase in December, maybe, but not by 0.75 percentage point. That's not what my forecast is. Maybe it's a quarter, maybe it's a half, but I think it's going to be a slower progression. And once they do that, I think they're going to ease back a little bit and then watch and see what the results of it, right? Because when those actions happen, when the Fed takes that necessary action to do what they say that they're going to do at any cost, the trickle-down effect or the result of such is not an immediate thing. So I think that what he communicated, what I heard him say is that it's going to be a slower progression, and then they're going to hang back, watch and see what the results of it was or is, and then make the next decisions going forward. So I'll say it again. Here's my forecast. Rates are going to continue to increase by some margin. I do not think they're going to go up as fast and furious, as violently as they have from the beginning of the year to now. Now, our audience already knows that increases in the federal funds rate, the thing that Jerome Powell and the Federal Open Market Committee sets, that those don't move in direct lockstep with mortgage interest rates. So a 0.75% hike in the federal funds rate, that doesn't increase long-term mortgage interest rates 0.75%, but there is that general loose correlation. A higher federal funds rate over time is generally going to correlate with higher mortgage interest rates, of course. So Talk to us some more then about the direction of mortgage interest rates, and to give some context, some perspective, some backdrop here, which is a real surprise to newer real estate investors, is that over the long term, the average 30-year fixed rate mortgage is about 7.75%. That's the rate. So we're still not quite at that point yet. But with that context, what are your thoughts on the future of the 30-year fixed rate mortgage rate, Caeli?
Yeah, I think it's an important point, Keith, that historically speaking, and investors are going to invest. The investors that have been investing long enough know that the rate is very secondary, maybe even in third place position to making any decision. 7.7 is the historical average. I think that if we're at 7 1/8 today, maybe we get as high. It's such a slippery slope. Okay, I'm gonna be direct. I'm gonna actually answer this question. My forecast is that by sometime between now and maybe spring next year, maybe we hit 7.625. That's my prediction. We'll see what happens. If I win, maybe I get a prize of recognition. If not, then I can be flogged. But I do think that obviously longer term, we're going to see rates come down. If I'm going to predict that or forecast that, let's say by the Fed has said that they plan to start lowering rates in 2024. That was their words. I think it's going to be sooner than that. I think we're going to see some reduction in interest rate prior to that. Let's say fall of next year, perhaps. But remember, everybody, rates go up a lot faster than they come down. Okay, that's just, I know they've gone up really fast this year, but just historically, I would not expect that when rates start coming down, that doesn't mean that they're going to go from wherever the threshold or the height is down a point, or they'll gradually be going down.
And of course, there are a number of factors that govern this. Some of the most widely reported ones are that we still have these robust jobs numbers that come in, which should be good news. More Americans are employed, but of course, the Fed fears that inflation is going to continue to run hot, so they will raise rates. So it's like good news ends up being bad news. And of course, they're looking closely at measures like the CPI inflation as well. So, what are your thoughts with regard to some of those larger economic forces on this future direction of rates and this very specific 7.625 forecast that you gave us for the spring of next year, which I love that you did that.
It's recorded, isn't it? Okay, we'll see. I think that overall, historically speaking, generally speaking, the better the economy is doing, the higher the rates are. That's just a matter of fact. If we ever find ourselves in a situation where rates were as low as they've been in the last couple of years, something devastating, something else in our sector, in our economy, or worldwide, or something devastating is happening that it would drive them down that low. So I don't know if I'm answering the question. I think that the stronger the economy, the higher the rates typically. I think that the hope is, once we get to that place where the Fed feels comfortable, I think that their target is 2%, right? To where they want to see that threshold, right? Yep. That, they'll start pulling back. Remember, you guys, interest rates on a whole should not be dictating whether or not you are playing in real estate or not. That shouldn't be the answer. You should be looking at the investment. You should be looking at it holistically. You should be doing the math. Is there cash flow? What is the appreciation of the home and the rents? What is the tax implication? How can I diversify my portfolio to offset some of these things? Different markets, short-term rental, long-term rental, mid-term rental, notes, or all the things that you already talk about, Keith. That's my answer.
Yeah, investors are going to invest. They don't try to get that market timing just right. And, if real estate prices are up, say, 25% in total over the last 2 years, well, if inflation is too, then real prices of real estate aren't up. We already touched on the fact that mortgage interest rates are pretty close to their historic average. And I think what you're telling us, Caeli, is get used to it. They're not going to be below 3% again, at least any time in the near term or the intermediate term. They were artificially low. So it's really get used to it.
Yeah, kind of. And I think that it's important that we not have those short memories. And as the market cycles shift, and that is as certain as death and taxes, we need to shift our expectations. This is a new cycle. So instead of having $400 positive cash flow on the single family residence that we've become spoiled with, now it's going to be 250 or 300. Yeah, get used to it. That's probably the best way to say it.
Yeah, I mean, it's still probably the best place to put your money today. And then the cherry on top of that is if you don't, of course, it is only going to be debased by inflation. Well, Caeli, in there at Ridge, you're different. You have so much repeat business there, including my repeat business. I mean, your company is where I get my mortgage loans myself. I've done my last few refinancings there as well. And part of this is that you're not just merely transactional, you're more relationship based. So just tell us about originating a loan through Ridge Lending Group in that process.
Thank you for saying that, Keith. Yeah, I'm glad to answer that. I really feel like we have done a great job of creating an environment for investors, real estate investors, where that holistic approach, it's not just a one and done transaction. And if that's what somebody needs, that's perfectly fine. But what we're about is coming up with a strategy based on their goals, teaching them how to understand underwriting guidelines as it applies to those goals and their qualifications. And then the availability of product, we'd be very hard pressed to find an investor that we could not secure financing for. It's really a well-rounded institution, I believe, for real estate investors. And I'm proud of that. And we're good at what we do.
And when I think about not being transaction based, look, what do most mortgage lenders do? Most mortgage lenders are making loans to borrowers for their primary residence. So they're just trying to get that borrower to go ahead and qualify for that loan and not do things like, buy their furniture for their new home before they close and things like that, or opening up new lines of credit. And they're just trying to get them closed for that one loan, that primary residence loan. But in there at Ridge, you understand the sequencing of things. You understand that an investor, they might want to buy a cash flowing property in a different state today and another one in, say, 6 months. So you know how to sequence things and see ahead and know to look in their behaviors. Well, wait, you don't want to do anything that might muddy up your debt to income ratio, or else you won't be able to get that next property in 6 months. So therefore, it would probably be better if you proceeded this way, for example, not transaction based, thinking about the long term.
Yeah, I'm so glad that you're giving these nuggets, Keith, because it's absolutely true. Non-owner occupied underwriting and guidelines and products are wildly different than what that owner occupied is. And the people that focus a large amount of attention in the non-owner occupied lending space is very, very small. So you've got me as the owner of this lending company focusing on investors. You've got loan officers, you've got underwriters, processors, even appraisers, all of these unique people that are in this orchestra of parties that help move the loan are specifically skill setted for investments. And that's what we also bring to the table. So, and it is very important, because what you don't know, you can play yourself out of qualifying, as you said, in 6 months down the road if you wanted to get another property. But let's say that circumstances changed outside of anybody's control. Even if that were the case, we have the product availability that says, okay, you can't qualify anymore for this. We can open up the box of tricks and say, well, we've got this, this, and this. We can still get you the loan.
I've talked to you, the listener, about how the team of professionals that you surround yourself with is often more important than the property itself in real estate investing. One long-term key team member might be your property manager, and another is your mortgage loan officer. And we're talking about why not just anyone can do that for you. So you can learn more and get started and build that long-term relationship where Ridge can really help you see your vision for building cash flow throughout your future. And again, you can do that at ridgelendinggroup.com. Caeli, do you have any last thoughts for us?
Give us a call, everybody. We're here on standby, ready to help you succeed in all your financial and real estate goals.
It has been valuable as always. Thanks so much for coming back onto the show, Caeli.
Thanks for having me, Keith.